Good afternoon, everybody. I'm Steve Gregorian, President and CEO of the Detroit Economic Club. Welcome to today's meeting. And I especially want to welcome our DEC members. If you're not a DEC member yet, please allow me 10 seconds to myth bust. There's no nomination or application process for becoming a member. There's no job level or salary requirement for becoming a member. We're simply looking for people that want to build their networks and hear from thought leaders like the one on our stage today. And you can sign up to be a member at econclub.org. As we get started, I would just ask you to silence your cell phone so we don't disturb today's program. And if you've been with us before, you know we always begin with a pledge and a prayer. So I would ask you to please stand and join me as we honor our country with the Pledge of Allegiance. And kindly remain standing as our invocation today will be delivered by Brother Nick Blattner from the Capuchin Franciscan Province of St. Joseph. Brother Blattner.
Thank you. Good and gracious Lord, you are the source of all goodness. Today, as we gather as one community, we ask that you bless us with the joy of fellowship, that as we discuss and share about the economics of our community, we may remember that your people are our work. We especially ask that you remember those who have fallen on hard times, for those who are hungry, cold, and homeless. May our conversations today be united with their sufferings. Lord of all that is good, we thank you for the gift of life. We thank you for the gift of friendship. We thank you for the gift of each other. Let us never forget your goodness to us each day. And let us especially remember the people of Ukraine as they suffer through the horrors of war and invasion. May you bless them with peace and safety and bring an end to war and division throughout the world. Amen.
Thank you, Brother Blattner. Everybody please be seated. If you've been with us before, you know we love having high school and college students with us. Today's no exception. These students are here courtesy of our generous corporate sponsors. Their morning already included a private reception with Mr. Evans. So I want to take a moment and let you know who is with us. We've got students from Chelsea High School, thanks to Linda Hubbard and Carhart. We've got students from Oakland Community College, Novi High School, thanks to Simon and Michael from ITC Holdings, Academy of Sacred Heart, thanks to Susan and Peter and the Detroit Free Press, Lake Orion High School, thanks to Elaine, Kaylee, and Tim from General Motors Company. So please join me in a round of applause as we welcome our students and thank our sponsors. A couple things you'll see on your table is a season lineup. You'll see a mix of in-person and virtual programs. Next up, May 2nd, we'll be in person with Business Leaders for Michigan, Executive Director Jeff Donofrio and one of their board members, Ron Hall from Bridgewater Interiors, and they're going to share their progress on their plan to make Michigan a top 10 state. We're making progress, people. I saw the report, but we've got a ways to go. And on May 11th, if you're a Tiger fan, probably our most exciting meeting of the year, and that's with our Detroit Tigers, where every player, coach, and manager are scheduled to attend. So we look forward to seeing you, and as always, watch your email on the website, because I promise you we got some more new announcements coming your way in the next couple of weeks. Also on your table, take a look at the sponsor brochure. We would not be here if it wasn't for the generosity of these terrific 120 companies. We really, really thank you for making sure we can do programs like these today, so thank you. And of course, the DEC has an incredible history of speakers that tell the history of our country. And Charlie Evans, April 11th, is a popular date in our 88-year history. You now join a distinguished list of 11 others who have graced our podium on this day. A few highlights. Way back in 1938, Rockefeller Foundation CEO George Edgar Vincent delivered a speech titled, "Is Democracy Doomed?" 1938. 1978, IRS Commissioner Lawrence Gibbs visited the DEC. So you see, folks, nothing's really changed. Democracy was threatened 84 years ago, and we're still here. And the IRS was in our pockets 44 years ago, and they still are today. So today, Charlie, we're pleased to add you as our 12th speaker on this day in DEC history, so thank you. I'd like to add this is also your third appearance at the DEC, so we're very, very much appreciative. And finally, folks, 2 ways for you to get involved in today's program. If you tweet, we want you to tweet using @DebtEconomicClub, and you can submit a question for Charlie that we're going to get to in the final 15 minutes using the smartphone, and instructions are on your table on how to do that. And those questions will make their way to our presiding officer, who I'm about to put to work. Linda Hubbard is the president and COO of Carhartt. She's also the board chair of the Detroit branch of the Federal Reserve Bank of Chicago. She is a DEC board member and a great friend to the DEC and to me personally, and also a great supporter of many things in our community and region. So ladies and gentlemen, please help me welcome Linda Hubbard.
Thank you, Steve, and good afternoon, Detroit Economic Club members and guests. It's my pleasure to introduce our speaker and moderator today. Charlie Evans is the president and CEO of the Federal Reserve Bank of Chicago, a position he's held since 2007. The Chicago Fed represents the 7th district of the Federal Reserve System, which includes Iowa, most of Illinois, Michigan, Wisconsin, and Indiana. In his role as president and CEO, Charlie serves on the Federal Open Market Committee, better known as the FOMC, which is the Federal Reserve System's monetary policy-making body. The Chicago Fed Bank also has a Detroit branch, and Charlie's very connected to the challenges and opportunities in our local community and ways that the bank can foster economic opportunity for Detroit and Michigan. Before becoming president of the Chicago Federal Reserve Bank, Charlie served as its director of research and a senior vice president. He's active in the civic community, and he serves on multiple boards. He received a bachelor's degree in economics from the University of Virginia and a doctorate in economics from Carnegie Mellon University. Our moderator today is Susan Tompor. Susan is the Detroit Free Press personal finance columnist. She's a graduate of Michigan State University and earned an MBA from Bellarmine University. Ladies and gentlemen, please join me and give a warm Detroit Economic Club welcome to Charlie Evans and Susan Tompor.
Well, Charlie, welcome to Detroit, and thank you for spending time with us here. It's great to see you again.
Thanks, Susan. It's always a pleasure to come to Detroit.
I want to go back to one of the times I interviewed you in 2014 when you were at the Economic Club. And back then, the concern was low inflation, actually, not something we're hearing about much on CNBC these days. Among the comments then you said, I am concerned that low inflation will run for too long, and that low inflation is just as economically costly as high inflation. Much has happened in the past 8 years. We're seeing inflation at 40-year highs. The February CPI was at 7.9% for 12 months. March comes out tomorrow, and I'm hearing some different estimates of 8.4 to 8.5. Some are saying it's a possible peak. What are your thoughts? Are we at a peak yet on inflation or not?
Well, thanks very much. You've covered a lot of territory going all the way back to 2014. And I always thought, this is the time when everybody gets to get even with me when I, sort of said inflation's too low, it's going to be hard to get up to 2%, and now we're in a period where inflation, February, the CPI was reported at 7.9%. So how did we get there? How did that happen? And is it going to continue? And all of the things that go with that. One of the interesting things about the February report is in the column just to the left of 2022 was the 2021. And a year ago, the CPI had been 1.7%, 1.7%. And the core CPI had been 1.3%. So inflation really leaped from a lot of things, and there were a lot of relative price increases with used car prices increasing 40% ultimately so far. New cars also a lot. Home furnishings, furniture up quite a lot. You can take 15% of the CPI that includes what I just mentioned, and that increased by almost 20% over that time period. The other 85% also increased quite a lot, 4%, 4.5%. So it's clearly the case that we have inflationary issues, inflationary pressures. They've come at us from many different sources: supply chain issues, semiconductor chips, labor force issues. It's hard to find workers, a lot of businesses say, and the unemployment rate, is really a pretty good 3.6% right now. But I do think that these high prices are going to persist longer, certainly than I anticipated. I thought it would be more transitory than it's been. I don't think they're going to be permanent, but I think it's going to be a while. And the Russian invasion of Ukraine puts added pressure. Agricultural prices, energy sources are going to be redirected and challenging. And so I think that that's going to be tough. And this is just a time where the Monetary Policy Authority, the Fed, has to be on top of this and reposition ourselves.
And why do you think it wasn't transitory? What were a couple of the factors that made things different than many had expected?
Well, I think initially some of the reports were, the car companies were having trouble. They couldn't complete assemblies. They didn't have a semiconductor. You kind of found out that these chips are in more places than you ever guessed. They were in the, if you want to move your seat a little bit, they were, there as well, not just in, sort of GPS and things like that. I think there was initially reason to believe that, the global COVID pandemic had shut down assembly in Indonesia, Malaysia, Vietnam, and there's sort of a two-part assembly for this, and so the chips themselves made maybe in Taiwan, then shipped to Malaysia. It took a little bit longer. Maybe that would work its way out more quickly. It turned out to be much more challenging. Then there's some industrial issues, which I just don't understand well enough. When the car companies sort of delayed their orders back in the spring of 2020 because who knew what was going to happen, right? People wouldn't be buying cars. Then before very long, they put in more orders. It's kind of like, oh, other people got in front of you, consumer electronics. There are all kinds of people at home playing electronic games. And did you know that the markups on those chips are more than the car company chips? And so I'm always amazed that the car companies were able to get as many chips. There's relationships and everything that works with that. But I mean, it's just a longer story. It's taking longer to play out. And there are many other things going on. Then there's getting goods into the ports coming across the Pacific Ocean, and there are never enough truck drivers. We've kind of known that for a long time, and now you hear it even more. You've got Amazon warehousing, and there's a whole secular change in how consumers are buying goods. Do I go to the store, or do I wait for Amazon, the delivery truck in front of my house, to show up and deliver things? And so there's a lot of transition going on, and prices have been high for a lot of that.
And for consumers, I think they really want to know when they're going to see more relief. More relief at the grocery store, more relief at the gas pump. We're starting to see a little bit of that here at the gas pump, seeing gas at $3.99 this weekend. It had been $4.25 in certain points. But where do you think we're going to start seeing some more relief when it comes to prices? And here's the trick question with that one: when? When and where?
I just think it's hard to forecast. I've kind of, if I initially thought that these were more transitory effects, I've learned that they're more persistent, and then there are new sources of unease coming from Russian invasion of Ukraine, all of the Russian oil. Even if we weren't buying so much in the U.S., other people were. How much is going to be re-diverted around the world? And so I think supply pressures are just more intense than I expected. Will they show some relief before too long? Hopefully. But there are oil tankers. There are only so many tankers. If they've got Russian oil in them, if nobody can unload the oil, then that's a tanker that can't be used for more deployment. And so there's just a whole lot of issues. I'm not an expert on the logistics side of that. And so I think we have to see it play out. When we actually see prices come down, that'll be an important part of that, and understanding the reasons for that. But I wish I could offer more confidence in that regard. I do believe that by the end of the year, we're going to know a lot more about the persistent properties, and I'm hopeful that they'll be receding by that time frame. And I think that's the time frame over which we'll be adjusting monetary policy and still be able to make choices about more or less in terms of restrictiveness.
And the Fed next policy meeting is in May, 3 weeks from now. The Fed raised interest rates the first time in what, 3 years, more than 3 years in March, up a quarter. San Francisco Fed President Mary Daly told the Financial Times April 1 that she sees a case for half an interest point increase instead of a quarter. What are your thoughts? Are we more likely to see a half going forward? And will we see rate hikes in between meetings? Or give us some kind of idea of where you think the trend line will be.
So I think so a couple of things are very clear. Interest rates are very low. They've been low for 3 years, as you mentioned. We only recently took them off the bottom, and we raised them by 1/4 point. We need to position monetary policy much closer to neutral, some neutral setting relative to where we are. We don't need, as one of my colleagues has said, we don't need an emergency setting of monetary policy anymore. The economy's doing well. The labor market is at 3.6% unemployment. Growth should be good. We might see a quarter of not so great growth in the first quarter, but that's partly the Omicron and some other inventory issues and things like that. But there's still a tremendous amount of momentum. So I think the economy should do well, and a neutral setting of monetary policy will continue to be consistent with growth and a vibrant labor market. I would say a neutral setting for monetary policy is somewhere in the 2.25% to 2.5% range. And I would say that it would be good if we got there, well, most recently I thought by the end of our next March meeting would be a time when we'd be at the 2.25% to 2.5% range. If we accelerated that so that we were there in December, that would be okay too. I don't think it's going to make a lot of difference those 3 months. I think that by the time we get to December, we ought to see whether or not we see some rollover in the inflation data, whether or not some other shocks make their way into our forecasts in ways that I never envisioned but could be problematic for policy, or whether or not they mean that some vibrancy is being taken away from the labor market and businesses. And so I think the optionality of not going too far too quickly is important. So I would focus the attention on where do we want to be at the end of the year. Now, the next meeting is part of how you get there and how quickly you get there. 50 is obviously worthy of consideration. Perhaps it's highly likely even if you want to get to neutral by December. That would probably require something like 9 hikes this year, and you're not going to get that if you just do 25 at each meeting. So I can certainly see the case, but I think the real discussion is about how you want to be positioned by the end of the year.
Is there a danger of going too high? I mean, when you start raising rates, what's the trade-off for unemployment, for the unemployment rate? Right now we're, I believe, at 3.6%. I mean, how much higher does the unemployment rate go when you talk about that many rate hikes in 6 months or 9 months, whatever?
So I think the first thing I want to say is I think that the policy approach that I just mentioned, that getting to neutral by the end of this year, I don't think that there's a great risk to the economy of doing that. I think that's getting off of the emergency setting for policy and getting to something that's neutral, that is neither propelling the economy further forward, nor is it actually expected to be holding it back. Now, the question is going to be whether or not inflation continues to be high and is expected to be high into 2023, and so we need a more restrictive stance of monetary policy. And if we have to be very restrictive, then obviously the way that policy would affect that inflation outcome would be in pulling back on the sources of demand. It would be in making businesses, reconsider some of their growth opportunities, hopefully into, a nice glide path so that we're still at sort of potential growth. But if you really have high inflation, you probably need to restrict the economy more. Now, I don't see it coming to that at the moment, because I think that many of these supply-driven relative price increases are going to give up some of those increases, lead to reductions in those segments of the CPI and PCE, and will ultimately get to a point where not too much of the increased inflationary pressures bleed across into other broader goods pricing. But that's the risk. And so there is a risk if we have to tighten too much. But there's also a risk if inflation continues to be too high, much too high, for too long. At the moment, I don't think that'll be the case, but we have to be eyes wide open about this.
And sitting here in Detroit, I've got to ask about car loans. I mean, it's a rapid increase in interest rates. It makes it more expensive to borrow. The average rate on a 5-year new car loan was about 4.15% a year ago. Estimates are that it could hit about 5% by March. And people I talk to say that might be $15 to $20 a month on a payment, which just doesn't sound like 15 to 20 a month on a payment, which doesn't sound like a lot, except one of my favorite people that I used to interview, the late Hoot McInerney, a local car dealer, once told me, he let me in on a little secret, that he didn't sell cars, he sold car payments. That's how people make judgments. They make a judgment based on that monthly payment. And the car companies have benefited a great deal from this low rate environment. If you go back to the 9/11 crisis, 0% financing was part of the catalyst that helped the economy recover. So I must ask, how much do you think higher rates could help or could hurt auto sales, could shut down auto sales from here? What is the concern with higher interest rates on car loans?
You described it very well. That is one of the transmission mechanisms. If we were to tighten monetary policy a lot, bind ourselves with very restrictive financial conditions, then consumer loans would be more expensive, and auto loans are a prime example. Suspect number one, perhaps even, in terms of what its implications for the economy. I almost feel like I haven't been doing my listening job adequately as I've talked to car experts over the last couple of years, because for the longest time I have also heard sort of, people come in to buy cars and they kind of have this $500 payment a month in mind, and if it's more than that, well, maybe they need less car, or maybe they don't buy a car, or they need less auto loan. So you get the lengthening of the auto loan to like 84 months, and you kind of go, gosh, that's a lot. But it's the auto loan being sold is a very common type of story. I haven't heard very much of that recently because you can't get cars, right? You can't see them on the lots. You can't, and so when I'm old enough to remember back in the 80s when so many of the Japanese nameplate cars were coming into the U.S. and being sold, and they had the surcharge on that sticker price, because people really wanted those small cars, and all of that. Surcharges on the retail is always a sign that it's hard to find these cars and whatnot. So people have been willing to pay whatever it takes, but that gets worked off, and you're going to get to the payment-sensitive buyer at some point, I would guess. I don't know where we are, how soon that'll be, but that's part of what, if we had to reduce demand more, we'd have to know more about where that point is and how it plays out.
Where that choke point is for the consumer.
Exactly, and it works out with home purchases as well, and construction, and all of that. Mortgages are more expensive now. And it's all very important. The future interest rate environment becomes important, right? I mean, I can imagine a conversation with somebody about, is this a good time to buy a house? Well, it never seems like a good time to buy a house because prices are always, too high, but you have to actually do this, right? And maybe mortgage rates are too high, but you do have the ability to refinance a mortgage if you continue to be in good credit status and all of those things. And so if there's an interest rate cycle, if you get in and you can work your way through that, that's also part of it. So financial savviness is part of this, but it can be really challenging when interest rates go up a lot.
Yeah, and you could refinance a car loan too, and so many people do that when their credit improves, and maybe they've gotten a double-digit rate on some lots. Where do you think, you mentioned the cars not selling above sticker price. One thing that surprised me about this economy is the bubbles. I see them as bubbles. As a consumer and as a journalist, housing prices, car prices, the stock market, virtual currency. I don't see how prices can keep climbing in some of these categories, but what is your view? Where do you see bubbles in certain areas, and were you surprised at all that prices would go up this much, given where we started 2 years ago?
I hadn't been paying attention enough to forecast the price increase that we have seen, so I did not forecast that. you know, I have been persuaded by a number of analyses that I've seen, read about, where after the you know, mid-2000s, when there was a lot of home building, where there was clearly a home price bubble and overextension with exotic mortgages and things like that, and that came crashing down, that after that, you know, the housing market really never got back to the construction pace that would have kept up with population growth, household formation, and so, you know, there's been less and less excess, you know, housing, if however you want to describe that. And I think all of a sudden, then you get to the COVID world where it's kind of like, oh, I'm going to be working from home and I don't have enough space. You know, maybe I need. You had a lot of people who, you know, their preferences for more housing. Maybe it was. I never get the age cohort exactly right. Millennials or whoever who had been holding off on buying a house. This was a trigger. You know, they were going to pull the trigger at some point and maybe move to the suburbs or buy more home in the cities and other places. And so I think that finally happened, and you know, home prices went up a lot. They went up around the country, which sort of which is different than the mid-2000s,
Right,
where it was sort of a coastal and sand state kind of phenomenon to a large extent. So I don't think of it so much as a bubble. It is a period of high prices, and it's extremely excruciating if you find yourself, you know, a buyer. It's a seller's market at the moment, but those things kind of tend to turn. They don't necessarily have to be, you know, a truly adverse unwind. It could just be part of the normal cycle.
And, you know, I want to go back to 2 years ago. At the start of the pandemic, we had a massive economic shock. And, you know, the Fed stepped in, massive federal efforts, including the stimulus programs and the easy monetary policy. Quick rebound, much quicker than many people even imagined. And even now, you know, we're witnessing pretty good employment despite those supply chain disruptions and a war, which is sort of amazing in and of itself that we've got this robust hiring. But what is your view about how the economy is doing today, including the Midwest and Michigan? You know, what kind of grade would you give the economy at this point?
Well, I think the economy has been doing very well. I think that you know, the spring of 2020 was just catastrophic. The public health crisis that we all faced, the risks that we just couldn't even get our heads around. You know, health risk. You know, lots and lots of people died. Fast forward a little bit, we learned more about the virus, its characteristics, how to stay safe, how to take precautions. It wasn't always pleasant, wearing masks, social distancing, not doing things out and about with people that we liked indoors. But, you know, we got through that. The vaccines came online and they're available to anybody who wants them, plus boosters. And so that's been an important part of this. And so now we can largely go on living our lives, if not exactly as we did before, in a very good way. And businesses found ways to produce goods safely, many services safely. It's just very difficult to know everyone's comfort level in going out and mixing, you know. So today it looks like everybody's pretty comfortable in a large setting. We're relatively close together. I'm sure there's a very good ventilation system here. We've learned so much about what the good characteristics of where it's safer than other places, and yet, you know, the variants are not by any means under control. The global ability of something to evolve into something more dastardly, it's a risk, so we don't really know. Midwest is positioned as well as anybody else. I mean, our emphasis on manufacturing is something that serves the region well. Goods production is high. In fact, it took me a while to sort of figure out, when I'm talking to a business person, they're saying, I can't find workers, I've got worker shortages. And then you poke a little bit more and you kind of go, oh, this is a manufacturer who's in a relatively small market and they're trying to add a third shift in an environment where they know that they're not going to have a third shift 6 months or a year from now. And so workers who have not previously worked there may not be encouraged to take them up. Is that going to take place at a higher wage? You know, things like that. There are examples of that. And then there are examples of, you know, home care, daycare, elder care is more difficult, and so people are reluctant to enter into the workforce. I mean, I think the Midwest has all of those challenges, just like everyone else. And so
What are you worried about with the workers? Are you worried about wage inflation at this point? I mean, with the workforce, you've got the boomers retiring, what do you see coming down the pike 2 or 3 years from now when it comes to the workforce?
So we've known for quite a long time that the U.S. population is aging. That's the way I characterize what you just said. The baby boomers are getting older, they're retiring, everybody's getting older. Birth rates are not high. And so, where are future workers going to come from? And this takes place very slowly over a long period of time. And I think one of the things we're struggling with, it's hard to get people's full imagination on this, I think, because it takes place very slowly. But if you think about the last 15 years, it's been a period where the aging has taken place. We had the Great Recession. We had a slow recovery. You didn't need the largest workforce because we didn't have the largest amount of demand. And so every year, we didn't really acknowledge that this was getting harder and harder. Then on top of that, add whether or not we have a tendency to enthusiastically embrace immigration as a source of additional workers. I think the answer is no, not enthusiastically, certainly. And that adds to this issue. Sometimes, I've been known to say, well, we need more 25-year-olds, and it's really hard to birth 25-year-olds into the workforce. It doesn't work that way. So there are all these issues. That also leads to lower sustainable growth rates. In the 80s, we enjoyed trend growth rates when the economy was growing on the order of 3.25%. Today, we think it's much more like 1.75%. Maybe it's lower. It would be great if technology advanced more quickly, although technological advance also typically comes with these transitional issues where you have winners and losers, and sometimes the transition is difficult as well. And so, we need more people in the labor force, and where are they going to come from? And we need improved skill sets. We need to make sure that everyone has as much opportunity, the ability to get education, to get training so that they can hit the workforce, be very successful, and we get productivity that way. So I think that's really very important.
And I wanted to ask you, the Fed, of course, says we're now at full employment. And that has been good. Fed gets a lot of the credit there. But the black unemployment rate now is 6.5 or 6.25, 6.25%, which is much higher than the rate for white workers at 3.3. How does the Fed define inclusive and broad-based employment, and how do we deal with such issues?
Well, I think we definitely take note of the unevenness of the opportunities that individuals have in the workforce. Education is an important part of that, making sure that everybody can have access to good jobs at good wages. That's going to bring forth the most productive workforce so that we can continue to grow. So we're always paying attention to the structure of the economy. Like I said, 1.75%, that's my guess as to what trend growth is going forward. I have to have a viewpoint of that because that's going to tell me where inflation pressures are going to start to kick in. That's also going to give me an idea of what neutral interest rates are. I said earlier that neutral short-term policy rates were probably 2.25% to 2.5%. That's not what we thought 10 years ago. We thought it was higher. In the 80s, it was much higher than that. But that's kind of related, definitely related, sometimes there's uncertainty, with growth rates for the economy, interest rates and growth rates. So lower growth rates, lower interest rates. And so low interest rates are good if you're borrowing, but if you're lending, you like higher interest rates. So there's just a whole bunch of things going on. We have to pay attention to all of that. I think the unevenness of the expansion in any environment, unfortunately, black unemployment has always been higher than white unemployment, Hispanic unemployment. And the increase in income inequality over the last 20 years, median household income for a family of four, $67,000. Mean average household employment, 97,000. From the median, 50th percentile, to the average is the 65th percentile. When we do average economics, we're focusing on the 65th percentile with a distribution around that. And it's sort of like, why don't we focus on the median? Why don't we focus on the opportunities there? And if the 65th is an interesting percentile of focus, why not the 35th percentile? We need opportunity for everybody, and I think you can see this with demographic breakdowns, regional breakdowns, and all of that. We just really need to reinforce opportunities and the skill mix and the ability of workers to contribute
And
and be compensated.
That's another good point there as well, right? Some commentators have focused on the Fed or accused the Fed of being overly concerned about racial equity, saying the topic is outside the responsibilities that Congress has given the Fed. The Chicago Fed recently started an economic mobility project. Can you explain a little bit what that project is, what its purpose, and how do you believe it fits within the Fed's responsibilities?
Sure, so it keys off sort of the comments that I just made about income inequality and areas of focus in terms of income percentiles and whether or not different demographic groups have access to the same opportunities. So it's incumbent upon us to understand the structure of the economy. That's the only way that we can always truly understand when the economy is at full employment. When there are no employment shortfalls, that's the most important thing. When there's shortfalls, we need to be working on that. When employment just keeps getting better and better, it's like, who am I to get in the way? Let's look at inflation. If inflation is low, why would I get in the way of a vibrant labor market? If inflation is a problem, we have to get on top of that. So that's sort of how that fits within our monetary policy ideas. And so it just turns out that there's a tremendous amount of inequality across demographic, racial groups, and that affects the structure of our economy and whether or not we can do better as a growth opportunity for businesses and workers and households. And so we had a nice event just last week where we showcased some of our research from the Chicago Fed, Bosch Mazumder, who's done cutting edge research in terms of inequality. What's the likelihood that if your parents were in a low income group, that the children would be in a low income group too? We like to think that there's opportunity and there's a lot of mobility in this. And he sort of showed that earlier research that indicated as recently as 1986 that we thought that there was a lot of mobility here. Not so much. It's really instead of, anyway, it's not as much. And it's even more difficult for black families than white families too. So there's a racial component to that. And then we had three economists, Wendy Adelberg from, used to work at the Congressional Budget Office, William Spriggs, professor of economics at Howard University, and Michael Strain from the American Enterprise Institute, and then talking about the challenges that the economy is facing and inequality. And there was general agreement there are obstacles for many workers in terms of their ability to get jobs uniformly, evenly across the economy. And then we had a conversation between myself and Raphael Bostic, president of the Atlanta Fed. So I think there's general agreement that we need to be focusing on the structure of the economy, the strengths of the economy. It comes in unusual ways. It's not the just look at the unemployment rate. That's a sufficient statistic. I wish it were, but there's a lot more unevenness.
What can be done though? I mean, what type of action or what kind of things?
Well, monetary policy really can't do a lot. I mean, we've got this one tool, which is the stance of accommodativeness. So it's either short-term policy interest rates, are they high or are they low? I think it's in terms of some research about the structure of the economy, what we learn, what we share with others, with businesses, convening people to talk about. But it really requires a whole host of additional issues. I mean, what Bosch Mazumder's work indicated that one of the determinants of lack of mobility comes from history of residential segregation. Another is quality of schools. And, I think it's easy to see from most of our experiences. I know growing up, being born in South Carolina, 1958, I saw evidence of segregation that continued to linger beyond any official ending of that. And went to a desegregated school in Alexandria, Virginia, T.C. Williams High School. You might have heard about it from the movie Remember the Titans with Denzel Washington. He was my gym teacher. The coach, the football coach or something. So, I mean, there are a lot of challenges, and we just need to keep working at them.
But it does hold back the economy, though. The inequality isn't just an individual issue. It does hold back economic growth. I mean, explain your position on that as to how economic growth can be held back for the whole U.S. economy, not just...
Economists are all about using every resource efficiently, and you know, workers are resources, businesses, workers, and making sure that they're employed and employed in all the best activities with the skill sets. And if you're having trouble finding workers, improving the matching possibilities. Just you know, in our own organization, I know that it's tremendously helpful for everybody. When you can see yourself in the leadership positions in the bank, you know, that's really inspiring for so many people, and it inspires others around them too. And not everybody can see themselves when I'm the president, but when they can, you know, see themselves in the management committee and my chief operating officer, Ellen Bromagen, and things like that. I think those are inspiring, those are important. It's sort of on the softer side, obviously. You know, good programs that support good educational opportunities, good training opportunities, equal employment opportunities are really important. And, you know, letting people compete and do the best that they can do on the basis of what they can contribute. That's important. And we get the most for the economy.
Do you have one top concern right now? And that will be my last question, but looking at the economy right now, what is your number one concern?
From a monetary policy standpoint, we obviously don't have the right setting for the funds rate, so we need to make that adjustment. And my concern is that as we need to get to neutral, and I think we need to allow ourselves enough time so that more data accumulates so that we can see better what we're actually going to be facing in 2023. And so is it going to be that some of these pricing pressures have crested and they start coming down, or are they going to stay high, or are they going to be, you know, higher? And if it's because of supply concerns, real resource pressures, there's going to be a lot of gnashing of teeth, angst over the inflation versus the concern for the economy. And I think finding the right balance is going to always be at a premium, and even more so. So I think my concern is that we take action to get to neutral, but we don't get outside of ourselves in doing that.
Well, thank you very much. This has been very enlightening.
Thanks,
I've really enjoyed it.
Thanks, Susan. Thank you.
you.
Yeah, really enjoyed it.
Thank you, Susan. Appreciate your questions of Charlie, and I've got a few more from the audience, Charlie.
Super.
I'm going to start off, someone submitted a question that said, what are your thoughts on the current levels of real disposable income for Americans?
Well, you know, I think it was very important and useful that both administrations, you know, the Trump administration, Biden administration, supported households during the COVID pandemic. It was very difficult when the economy sort of shut down and the period of opening it back up, and so those support payments kept household incomes up. They were very generous programs, and there's been a lot of commentary about maybe they were a little more generous than they should have been, but I think that they positioned households very well during a very difficult time, and the fact that vaccines came along more quickly and we're in a better position than I would have guessed we were going to be. That's a good thing. I'm glad that they took that chance. And I think that's part of it. I think that that'll be coming down in terms of the fiscal support because it's waning. I don't think we'll see another version of that anytime soon. Hope it's not necessary.
What impact would workers coming back into the workforce in earnest have on the economy?
Well, lots of businesses say that there's a tough time finding workers, and so it would be great if this provided relief for that. As an economist, you know, I think there's always a price. So, I mean, part of this is what are the wages that are being offered? What are the terms of, you know, the employment? What are the business models that have been, you know, tried? So I think in goods production, it's pretty well understood. And businesses have made adjustments when they've had to raise wage. They tried bonuses, and if they could, do it temporarily, that worked. But then they raise, wages and some other things. But that's fairly straightforward, painful for businesses, good for workers. I think on the leisure and hospitality small business side, it's far more challenging because the business model, the margins are probably very small, very thin. And so wage increases really can, turn the tide, against a small business, model. Some are resistant and others are probably not going to be able to survive that. So more people coming in and being available would help. Higher wages would challenge the business model. There are probably business models that worked before that aren't going to work anymore. For instance, if you had so many businesses do, it's like, you schedule somebody and then the customers don't show up. And so you send your workers home. Or, maybe you schedule more and then anyway, you send people home and, maybe they don't get as many hours as they wanted. Well, to the extent that workers have options, they're going to find employers that provide them more secure hours and things like that. So if that was a critical part of your business model and you can't get around that, I'm not quite sure how that's going to play out. It's going to be tough.
Do you think that U.S. national debt of $30 trillion represents a long-term threat to the U.S. economy?
Obviously, debt is something that, you have to pay interest on the debt. If you're a household, you tend to think that you have to pay it back. Somehow governments don't always have to pay it back. They just keep extending it, and next thing you know, you grow into it and that type of thing. Nevertheless, servicing the debt can be very burdensome, so that is a concern. I am reminded that when one of the first times I spoke after the COVID shutdown, I said, this is going to be very difficult and we are going to be poorer as a nation, because how can you shut down the economy for 2 or 3 months and not have that be a loss? Now, the economy came back so quickly and we're back to where we used to be. I kind of rethink that, and it comes back to the fact that, well, the government took on a lot of debt to make people better off during the downturn, during the public health crisis. That, in my mind, is an appropriate use. That's why we have a federal government, and it worked out. So this is the side that we're poor. We're going to have to somehow give up on something, or it's going to pressure these things, or we can grow into it, if we have really good growth policies. And some of that 30, trillion is, a business would be kind of thinking, well, some of that's capital investment, and I'm making a return on that investment, so it's going to pay for itself, or I know how to pay for it. We're not very good at splitting that out. Some people think that there's never a payback on that, but I'm not in that camp. I think that quality infrastructure investment is a good thing.
This is submitted from one of the college students in the audience. What steps do you and other Federal Reserve heads take to make sure you and your decisions are perceived as nonpartisan, and has that changed in recent years?
We try to be nonpartisan in the way that we think about it. That's the first thing. Just in going about doing our job, we try not to take positions that are partisan. I know that working with my predecessor, Michael Moscow, he came in and sort of opened up more public events that we did in the Chicago Fed. I learned from him, and it's very important to have balance in how we think about these things, right? So, it's kind of easy to have critics come in and look at what you're doing and kind of go, wow, you're kind of leaning to the right on this one, or you're leaning to the left on this one. And so having balance is important. I think in the current environment, things are, is it political to say that things are more polarized? There's just, great dispersion in, how different democratically elected officials think about the economy going forward and all of that. And so it's almost like the Overton window has moved in ways that make so many things appear partisan that didn't previously appear to be that way. We try to keep our head down, take actions that are for the benefit of the American people, that benefit American households, that support businesses. And the test is that we end up with strong economy, vibrant labor markets, and price stability. I think at the moment it is way too early to say that we have let the price stability side of our mandate get out of hand. Oh, inflation is too high, there's no doubt about it, and we need to reset that. But I think that the relative price increases have been extraordinary. We need to be mindful of that and try to find the right setting of the economy that returns us to 2% inflation on average before too long, and maintain as vibrant a labor market as possible. So it's actions that really matter, and I can't, people are always going to be criticizing us.
I'm just going to finish with this last question, which I think you've given your point of view, but in a recent survey, the economy has majority of Americans concerned about a recession, with 81% believing one will happen this year. Should we be worried?
Well, I think that at the moment, I think that there's good momentum for the economy, that the vibrant labor markets will continue, unemployment will stay below 4%. I think it'll be 3.6% or lower as we increase policy rates up towards 2 to 2.5. So I wouldn't agree myself with that 81% figure, but I do think that we need to be mindful of, as we get to neutral and we get a better idea of what the inflationary pressures are, and we see how things are playing out with the Russian invasion of Ukraine and the sanctions and everything else, hold our breath and hope that things work out globally, and the COVID global risk as well. There's a lot to hope there, but I think that there's still a good chance that we'll see continued growth for the next few years, and that's as far as I can forecast.
Charlie, you've made it through the easy part of the session, and now we're going to the traditional lightning round questions.
Okay, those did scare me, actually.
So, something on your bucket list?
I don't really think in terms of, we love national parks. We go out to Jackson Hole and Yellowstone every year. And I think going to see some of these national parks that you can see in all those westerns that people are, riding horses through, I think that's part of our future.
One of your favorite movies?
Oh, so during the COVID sort of be careful kind of thing, we started doing driveway movies in our neighborhood. And we found out, it started off as my wife buying a projector for $150, and then it, I had to buy speakers so people can hear it and all these kinds of things. So we're totally invested in this do-it-yourself kind of thing. But we show movies for our neighbors on our garage door, and we saw the Bourne Identity movies. Those are very popular, and Driving Miss Daisy I thought was very good. It was very poignant in the current environment where you see the comedian Dan Aykroyd talking to his mother Jessica Tandy about why he won't be attending the meeting to go see Martin Luther King, because, well, I have great respect for him, but a lot of the business people I work with, they might not think about me the same way, and I have to worry, and just worry about all the things going on today, and how it's important for us to just speak out and think about what's important for America and all of that. So,
describe Detroit in one word.
Motor. City? Can I say city? Yeah.
That works. Yeah. And then just to wrap it up, advice to your 25-year-old self. What would you tell yourself?
Yeah, I think it would be to keep going. You didn't ask the question that was on there, what did you always want to be? And for me, it's really boring, an economist. And at the age of 25, I was in that, I need to go to graduate school, I'm going back to graduate school, and I'd like to study the economy and macroeconomics, and I could never have guessed that it would work out as well for me to have a job like this, to interact with so many wonderful people and share my views as one of only large number of people, but try to make a difference in terms of the setting of monetary policy and all of that. So keep going. When you have a dream, go for it. 25 is still very young.
Thank you, Charlie. Thanks for your time today. Susan, thank you. Now I'll turn it over to Steve.
Thank you.
Thank you, Linda. Charlie, this is your third time with us, and each time has been a delight. So Thank you so much, Susan and Linda. Thanks so much for your time and talents. Folks, 2 things for you. Tell your friends and colleagues to join the DEC. We're fun people. And the second thing is, May 2nd, hope to see you with Business Leaders for Michigan. We'll be at the Motor City Casino for that one. So on time, every time, this meeting of the Detroit Economic Club is now adjourned. Thanks for coming.